it always came back to that again in some form or fashion. And Dr. D, in a way that only Dr. D can do it, he just looked at me and he said, James, just tell him to keep making more money. And so towards that end, what we did was come up with this concept, this goal that we had, and that was to show our customers and clients that you can retire with peace of mind, knowing that you can steadily grow your portfolio, generate income, and preserve your capital. Okay, by using the three core strategies that we're going to talk about. We believe that a secure retirement is one in which you have enough income to live the life you desire. And you can see these folks here. They actually name their boat after VectorVest. And then finally, we believe that a secure retirement is one where work is optional and retirement is affordable. So how do we get to that peace of mind? Right? How do we get to that peace of mind? Well, we break it down to three, again, the three core strategies, and we put them under this umbrella. First is profit, provide, and preserve. Okay, so when we start on the profit side, what are we talking about? Mainly, we're talking about capital appreciation, finding good quality, safe stocks, rising in price in a rising market so that we can grow our portfolio. We want to do our best to keep you off that roller coaster when your portfolio is moving up and down and you're not prepared or not sure what to do when things get a little choppy. And we want to take that from the roller coaster to a nice steady climb. Okay, so that's the profit side. We're going to talk about provide. And what we mean by that is providing a safe, steady income. Okay, a safe, steady income. We don't want to just have a couple of maybe some dividend stocks that have a few bucks trickling in now and then. We want to be able to have a safe, steady flow of cash into your portfolio. And then finally, I'll say many times through the course of this, is preservation of capital, I believe, is the most important. We want to be sure that you go from being unprepared to knowing what to do when the market begins to turn against you. And it will. The market is on another big day today. There will be times where you think you have no worries, right? Like our boat look like until you do. And so we want you to be prepared. Um, the great money manager, hedge fund manager Ray Dalio had a great quote that I like to use, and he said that you can't make money in the market without taking some risk, and you certainly can't keep your money without being defensive. And so you could build your portfolio and have your unrealized gains, and that's great. But if we don't know how to prepare to defend and preserve that capital, that net worth, your net worth, then we'll have troubles. So that's our goal here today. Let me start just so I can get an idea what some of the folks what you guys are thinking. What's the hardest part about preparing for retirement, or if you're already retired, where you're at? Just if you could just type in a few things so I can get a sense of where you guys are at with this. And there they go. Yeah, William says finding the right stocks. Yeah, that's always when you're that's the building part, right, William? We got to be sure the market's rising. We're finding good quality, safe stocks. Hamden says living cost. Yep, there's homework you have to do to know how much you're going to need. Gary says, yeah, unexpected events. You've got to be prepared for that. What Tom? I like the way Tom phrased that. What to do in the current illogical market. I like that phrasing, Tom. And yeah, that all falls under that be prepared part, right? Rakesh says zero rate income, right? So it's tough to go out and buy, whether it's treasuries or corporate bonds. There's no interest rate to generate income. That's a great point, and we're going to talk a lot about that today. Uh, John says I waited too long to start, and John, what we like to say is it's never too late, right? We'll talk about that later too. It's never too late. So hopefully some of the things we talk about today can get you heading in the right directions. Um, and yeah, so I'm reading through. I can't. There's a lot of them coming through. I can't read all of them. Just when to sell was one of them. Okay, great. Yeah, so I think what you folks are putting in here are very legitimate concerns and things to work on as you build and manage your retirement portfolio. But from the sounds of it, I do think you guys are in the right place today. So let's jump in and talk about these three core strategies and how you can at least begin to build that foundation to do this. So we're going to talk about capital appreciation first. Remember, this is the profit side that I talked about. We're going to then talk about income. And when we get to income, there's going to be two parts to that I want to dig into. And then finally, and I'll, it's I'm a creature of habit. I can't say preservation or capital preservation without qualifying it with the phrase, and perhaps most importantly, capital preservation. Right? Capital preservation is perhaps most important here. So let's start with capital appreciation. And again, it falls under the profit header, and it's capital appreciation comes from owning companies with consistent and predictable financial performance. In other words, good quality, safe stocks. And I always say, what two better adjectives to describe the type of stocks that live in your retirement portfolio than consistent and predictable when it comes to financial performance? Okay, so I forget who typed it in, but finding the right stocks is a huge start to beginning to build your portfolio before we even get to the management part. So Dr. Delito said many times and has written many times, good portfolio management starts with buying the right stocks. Now, I use my baseball example here. I'll use some baseball analogies as we go through. Being from the New York area, the '69 Mets were my favorite team growing up, and the reason they're on here is because I want you to think about building your portfolio. You putting the right stocks in your portfolio is like managing a team, whether it's baseball or whatever sport you want to use. Right? Gil Hodges was the manager, and he made sure he had the best players on the field. And it's very similar when you talk about stocks. You want to put the right stocks in your portfolio the same way you want to put the best players on uh, um, on the field or on the court or on the ice, whatever sport it might be. And so I do this, and I always make sure if there's anyone from Chicago who remembers the '69 baseball season, I apologize for that if anybody gets that. Okay, so to do that, to build that roster of players or the best portfolio you can of stocks, it really all begins, excuse me, with safety. Safety first. In other words, for our retirement account and primarily for our growth or capital appreciation portfolio, you want to look primarily at companies' safety more so than anything else. And I'm going to explain what we mean by safety here at VectorVest. And the idea is, while it's fun to hit the home run, continuing the baseball analogy, we know what happens to most home run hitters when they don't hit a home run. Right? What happens to most home run hitters when they don't hit a home run? Yeah, exactly. Donald's a strikeout. Yeah, everybody's typing in. Yeah, Babe Ruth. Well, Babe Ruth used to hit for high average too. But that the idea here is that we're not out to buy the $2 stock and watch it go to 32. That's not really our goal here and what we're going to talk about. It's not the type of stock that we're going to talk about. Okay. So when we look for our stocks, when we find these safe stocks, there are certain things that these companies have in common. Okay. There are certain things, certain foundations that these companies have in common. And for our purposes here at VectorVest, they are comprised of these six pieces of information. There's earnings consistency, company size, price behavior, longevity, dividend history, debt to equity ratio. These are all important factors that go into determining whether a company can sustain itself, can continue to grow. And what we do at VectorVest, Dr. Delito created an indicator called relative safety that I'll talk about in a moment. And he took all this information and he funneled it through formulas that he created to be able to rank and analyze these stocks all on the same level. So when we look at this information. This is fundamental information for the most part. Price behavior is part of it, but you can go out and try to do the homework and do the legwork to get that information. But I guarantee you're going to get buried by all of the data that comes out. Okay, there's a lot of stuff, and it's not easy to do. We go out and do it for you. We take that data, we funnel it into the VectorVest program where it becomes actionable information. Is the bottom line to what we do. So uh, if you try to look that all up on your own, you're gonna get a lot of headaches. So what we've done is we've created, or Dr. Delito created, this relative safety, and it's an indicator of risk. And that's where the consistency and predictability phrase comes from. That's the definition. It's the consistency and predictability of financial performance. Those are the primary factors in assessing relative safety. Okay, so again, we talked about this checklist, and when we check the boxes on all of these pieces of information, we're able to find the quality stocks. And let me just kind of illustrate what type of stocks those are for what we want to look at. So I have West Pharmaceuticals here. I choose West Pharmaceuticals for a few reasons. Number one, it's a very high rated, ranked relative safety stock. As of less than a week ago, when I took the screenshot, it was at one. Remember, all of our indicators, except for one, which I'll talk about in a bit, all of our indicators are on a 0 to 2 scale. The relative safety number for West Pharmaceuticals just last week was 1.46. Now, what we're looking at is a 5-year graph of this stock. And then down below, this is the VectorVest earnings per share. Right? We use a formula that gives us a historical combined with a forward-looking forecast on earnings, and that's how we calculate earnings per share. So I've got a 5-year graph here, and the takeaway here is the visual of earnings per share rising, strong earnings per share growth, and what happens is the underlying stock has that same northeasterly direction. Right, the price of the stock rises, and if that doesn't look like much of a move, remember these are $50 increments over here on the log. So, these are some big moves to the upside. So that's a 5-year look. Consistent, predictable financial performance will get us the right stocks at the right time. Okay. Now, the another part of the one of the boxes to be checked is not only earnings consistency, price behavior, but it's also if the company pays a dividend, it's that dividend history. And so one point I want to make on dividend history is that you don't have to pay a dividend. The company doesn't have to pay a dividend to be considered a safe stock. There's a lot of them in our program, a lot of high ranked RS stocks that don't pay a dividend. But the key is if you do pay a dividend as a company, you darn well better continue to pay it and grow it even year over year. So again, this is a 5-year look only, and what I like to call the golden staircase, right? This is a dividend that's growing. West Pharmaceuticals happens to be what's called a member of the dividend aristocrats. It's a S&P 500 company that has not only paid but has grown their dividend year over year for at least 25 years. And I'll show another example of that in a little bit. But West Pharmaceuticals again falls right under that. Okay. So yeah, John says West has a high PE ratio. Yeah, we're really not looking at it. We're looking at the longer term here, and there's not a lot of stocks right now, to use Tom's phrase from earlier, in an illogical market that aren't trading a little bit above their earnings. So, again, we're looking more at the fundamentals here. Dr. Delito created relative safety because he never believed earnings per share or a PE ratio gave you the real foundation of the quality of the underlying stock. It's really glad you said that. It's really the reason he created relative safety. So we get to debt to equity ratio. Finally, this is an important one, especially in times like we're seeing now. I won't go through the textbook definition here, but a favorable debt to equity ratio is important for companies to be able to weather any kind of headwinds that they may run into, whether it's the overall economy or something specific to the company. Obviously, having a more favorable debt to equity ratio will allow them to get through. That's a big part of the consideration for a high RS stock. Okay, very important. Okay, so one example of how we find these uh, high quality RS stocks, and there's several ways. There's a bunch of ways to find them in the program. Um, there is a search in our Unisearch tool called Ruler Stocks. Now, Ruler Stocks brings back stocks that have at least an earnings growth rate in percent per year of 14%. The relative safety indicator, again on a 0 to 2 scale, has to be what we consider excellent, 1.4 or greater. And then we sort them by relative safety times growth rate. That's the combination that comes to the top of the list. Now this list was screenshot was taken a couple of months ago at this point, but you'll see a lot of well recognized names here. You'll look at the relative safety numbers are all very strong, with the exception of one stock. They were all buy rated stocks, and the fundamentals and the earnings growth rates, they all fall into place when the relative safety numbers are strong, and certainly the dividend information does too, as we'll see in a bit. Okay, so there's a lot of different ways. My favorite search, one of my two or three favorite searches, is ruler stocks. So this is one way to find the good quality stocks. Now, just real quick, because I talked about ruler stocks, and we'll leave West Pharmaceuticals up here one more time. Ruler stocks are named because the idea is you can put a ruler, and whether it's earnings or the price of the stock, and you can draw just kind of you can make points and have a pretty much a straight line on the movement of earnings and growth. Now, as we know, nothing goes straight up, so nothing goes straight up, but you can see that earnings performance and the stock behavior. So that's why we like to call them ruler stocks. Okay, yeah, and Stephen, all you do is go into the Unisearch tool, you go into the prudent folder, and you're able to find those good quality stocks that look like this. It's a great search. Again, one of several that we like to use. So I'll go back through there, and let's go into a portfolio that focuses on high safety stocks. So I can talk all day about the quality of the stocks and the way we go and find them and the importance that we put into those boxes on the checklist. Okay. But here's a portfolio that has been in place now. This is a model portfolio that we manage in our Tuesday retirement coaching group sessions here in the Retirement Services Division, and it's 3+ years. So not just looking back. Listen, I could show you a quick test from March 23rd when the market bottomed out and tell you that ruler stocks have been doing unbelievably great, but so is it mostly everything else, right? As you can see, again, we did have drawdown here, and I'm going to talk about that later as well. But you can see from that March 23rd, we've had a big move. In fact, in just about 3.5 years now, following a very specific management technique, risk management technique in this portfolio, we're up over 120% in 3.5 years. And before you do all the math, it comes to, again, this is about a week ago, I guess. It comes to about 33.33% annualized rate of return. 33% annualized rate of return. Now, if you're wondering and want to compare that to something, I did what we call run a quick test. And again, I built this just not even a week ago. This is the date the portfolio was created, right at the beginning of the year. The S&P 500 is up 49.79% or 13.75% annualized. Okay. So just to give you some idea of the comparison when you build and manage the proper way. And again, I know this stands out, this drawdown here, but we're going to talk a lot about that in a minute. All right. So finding the right quality stocks, safe stocks at the right time. Again, we know nothing goes straight up, and as we saw, we have drawdowns, but we're going to keep you off that daily roller coaster ride. So I'm going to ask you to stay involved with me. Type in, which would you rather have? Safety in the underlying companies that you own, or no safety? Or do you just disregard the checklist that we talked about? Which would you rather see, no safety or safety? I know we all know the answers, but let me know that you're with me here. Yeah, everyone's typing in. John, Mark, Jeff, Gigi, William. Yeah, safety plus RT. Alan says. Yeah, we don't. I'm not going to talk too much about relative timing today, um, but yeah, having the market and aligning that trade with the right market trend is important. And yeah, Michael says, yeah, definitely safety. I feel conservative is more important for retirement age. And that's the beauty of all this, Michael, is that we're going to be conservative and we're going to be prudent. But that doesn't mean we have to give up. As you just saw, the returns against the S&P 500, we're not giving up capital appreciation and safety there. And Gregory, great segue because Gregory wrote in steady income, and that's where we're going to go next. Okay, that's where we're going to go next. So I'm going to shift gears a little bit here. Right. First, we talked about capital appreciation. Finding good quality, safe stocks in a rising market is key. And then, of course, managing that portfolio with specific risk management techniques. Okay. All right. Next is income. And Hendrik, stick with me because I disagree with what you said, and I think you will too by the time we're done. So, income. Let's talk about generating income. So, I'm shifting gears here from capital appreciation to talking about providing that safe, steady income instead of having just a few pennies trickle in from a random dividend stock. I want to talk about part one of a steady income flow. First, we're going to talk about dividends, and I'm going to preface all this now because it says covered calls on the page here. First, I'm going to talk about building a quality dividend growth portfolio. Okay. I'm also going to talk in part two about generating income with the most used, the most basic option income strategy there is, which is covered calls. It's the most popular and it's the most basic. Whether you're brand new to options or have been trading options for 20 years. So if you're in the room right now and you've never traded options or very rarely have used options, stay with me because it's not designed to turn you into an options trader. You don't have to be an advanced expert in options to understand two basic trades, which is selling covered calls and using put options as an insurance policy. Okay, so understand that as I move forward. I'm saying that now because the phrase covered calls is on there, and I just want you to know that I believe selling covered calls and understanding how to and what a protective put or an insurance policy is a necessity if you're here to learn how to build and manage your retirement nest egg, your net worth. Then these are two important pieces of information you need to have. Okay, I'll get off that soapbox and let's talk about dividends first. Okay, so part one, talk about dividends. And the goal here of this core strategy, of course, is to get paid. It's to get paid. So you can go into Google, you can Google all kinds of things under, something as basic as good dividend stocks. And you'll get, how many? 850,000 results. What you're going to find is most of these lists and websites that you go to are simply going to sort and give you some names, and they're never going to tell you the quality of the dividend or give you the characteristics that are important to let you know if they're a good quality company paying that dividend. They're just going to sort by the yield. And what we definitely don't want you to do is just chase the highest dividend yield thinking that that's the best dividend payer out there. Right, here's another one. You can just barely see it down here that's sorted by here's a 32, almost 33% yield on a $4, in this case, an investment trust. Right, dividend.com is another site. I mean, there may be good information. I don't know, but just to go and try to sort through these, you have to go do the work on your own. So let me show you one of the things that we do here. We have in the VectorVest program, when you click along the main toolbar, you go to the Viewers tab, and we have what's called the watch list viewer. Now within that watch list viewer, we have a dedicated folder for dividend paying stocks, or ETFs or closed-end funds. I'm not going to go into all of those. You'll see the one I have highlighted here. It's called DRIP 25 Plus. DRIP stands for Dividend Reinvestment Plan. And nowadays, your broker, you can talk to them. Usually, there used to be a charge for it. Usually, you can do it now and just set up to have your dividends automatically reinvested into that underlying stock, even with fractional shares. So, if you don't need to pull those dividend payments out, whether you're using it for to pay bills, buy a new refrigerator, go on vacation, whatever it might be, you can always pull it out. But if you're not taking those dividends out, I strongly urge you to reinvest those right back into the stocks. So what we have here on the DRIP 25 Plus, again, these are stocks that have not only paid but have grown their dividend for at least 25 years. Okay, it's at least 25 years. So you'll see, again, just as of last week, Lowe's, which had a great earnings report last week, relative safety at 1.43. It is the highest ranked VST, value, safety, timing. So it takes all of our core indicators. That's how this list is sorted. Okay. But it's a great place to find, again, companies who have that strong dividend history. We also have a DRIP 10 to 24 years, which I'll talk about in a moment when we look at a search to build these portfolios. So any stock, we want it to at least have grown their dividends for at least the last 10 years. But here's a great list. You'll see T. Rowe Price is number 4 on WST is number 2 on this list. Sherwin-Williams, T. Rowe Price, a lot of recognizable names here. Target is down there. I think they just had great earnings. So you'll see all these familiar names on this list. One of several great ways to find those quality stocks is we use a search called blue chip dividend payers. Again, one of several that we use. What we have here is just I created this search, I don't know, almost 3 years ago now. The stock watch list, it has to come from either the Dow Transports, Industrials, or Utilities, or be in the S&P 500. Okay, so it has to be a mature stock, I guess you can call it. Stock dividend yield has to be at least 3% to make the list. 3% or greater. Okay. We want stocks only from the 10 to 24 or 25-year list. So in other words, at least 10 years. And then the dividend safety. This is the one indicator in VectorVest that's it's not on 0 to 2, it's 0 to 99. We want stocks with a greater dividend safety, greater than or equal to 50 out of that 0 to 99. Why? Because what that does is allow us to feel secure that the dividend payout ratio is favorable. In other words, is their earnings per share greater than their dividend payout? Or another way to look at it is their earnings yield greater than their dividend yield. So as long as they're not paying out more money than they make, that would be a favorable or positive payout ratio. And so that's what we look to do there. Now, again, with these type of parameters, one of the stocks that came up, I mentioned T. Rowe Price. I love this stock. I own it. I sell covered calls against it. Do a lot of things with this. So this actually is a 25-year graph, and you can see again what I call the golden staircase, how T. Rowe Price has grown their dividend every year for at least the last 25 years. And a company that does not have, the earnings behind it won't get that price pattern and won't get that steady dividend growth. So again, not only do we get the power of dividends and compounding if we reinvest them, like I said, no stock's going to go straight up. And in fact, with these type of stocks, I know without even really looking, especially on a long-term graph, this is 2008. This is October of 2018, which a lot of folks I talk to forget what happened in October of 2018 to Christmas Eve. And then, of course, this is the recent sell-off. So the highest quality stocks, you're going to see drawdowns over those 3 time frames over the last 12 years or so. But this is the kind of stock that we look for, and when we're looking at the characteristics of a quality dividend stock, this is what we look for, and this is what it looks like. So just as I did with the growth portfolio. We have another portfolio I began much longer time ago. Again, we started this here uh, in retirement services. I created the search about 3.5 years ago. Ran it. We started it with kind of a back test from 2013. At that point, it was a 5 year look back, I believe, or maybe 3 year. But we kept the portfolio going. And what we have is a portfolio, and this one is, since it started in January of 13, this is 7.5 years, because we're looking at a longer term for our dividend portfolios. We've got a little bit more of a longer term outlook on that. Okay, so we have 118.69% gain. Again, this is just from last week. Again, I'll talk about the drawdown in a little while. That is a fifth, almost just under a 16% annualized rate of return. Okay. Now, again, as I did in the growth portfolio, if you're curious to know how it performed versus the S&P 500, well, the S&P 500 was actually up a little over 17%. Okay, so that's just the capital appreciation. Now, what you have to understand from this graph is that what this equity curve does not include are the over $33,000 in dividend payouts that were paid out over this time frame. I calculated that down to almost to the penny up till about 3 months ago, when I stopped counting, because the point gets made here. I went through the life of every round trip trade in this portfolio, which aren't many, and I calculated the dividends, and it's over $33,000. And yeah, these stocks would have been, uh, again, there's a strict management technique to Pat's question there. Yeah, you see this flat line. We had no positions. The management technique had us in cash at one point, and we did mitigate this drawdown. Um, but yeah, stocks would come in and out, and that's where we are. And then the other thing, real quick on this, is that not only does it not include the $33,000 in dividends, by the way, which would put it at roughly 20.25% annualized rate of return, give or take a click or two, which does put us, a good 5% or more higher than the S&P 500 over that same time frame. Right. So when we add the 33,000, our gain isn't 118,000; it's 100 and whatever it comes to, 52 or 53,000. Okay. So we get the beauty of both capital appreciation and the dividend payout. And the great thing about specific portfolio is that there is not a lot of round trip trading going on. Someone commented earlier, it's just, kind of buy and hold or set it and forget it. That is not the case in any of our portfolios. It doesn't take 4 hours a day in front of your screen to manage these things, but in no way is it the idea that you just set these and don't worry about them. Okay? We're always going to be proactive, always going to be proactive and manage these portfolios. Okay. Now, those are the qualities and the results we can find when we build a quality dividend growth portfolio focused on the key characteristics of a quality dividend stock. I said part two would be the covered call section. I'm going to break down what a covered call is and why you should be using them in the most basic jargon. I'm not going to use option terminology. I could, but I'm not going to. On the importance of covered calls and how you can make them work. You can provide income with covered calls. Think of it as charging rent to the stocks that live in your portfolio. Right? We want to collect rent, so we're going to sell call options against those stocks. Okay. In other words, we're going to sell. Well, let me bring up the slide and show you exactly what we're going to do. We're going to provide income. There's a gentleman named Lee Lowell. He wrote a great book called Get Rich with Options. And he went through a handful of income trades, and one of them was the covered call. And I still think this is the greatest, most straightforward, logical definition and why you should be using them. Okay. Again, not to turn it into an options class here, so I love the way he phrases this. If you own shares of a stock, it has to be at least 100 shares, and you're not selling call options against them, you're throwing away free money. And he asks, how's that? And here's the definition. There are other traders out there who will give you money today for the right to take your stock away from you if it reaches a much higher price. So selling covered calls is such a great strategy for padding your bank account. I still can't believe there are investors who aren't taking advantage of it. And frankly, neither can I. I mean, it's a wonderful way to generate safe, steady income. Now, here's the definition. There are two parts to it. The first one is called a buy right. Okay, you buy the underlying stock and you sell or you write the contract. Okay, writing and selling are synonymous, so it's called a buy right. Now remember, a call option gives the owner, the buyer of the call option, the right to buy ABC stock or whatever it is, 100 shares at a certain price by a certain date. It's a contract with strictly defined terms and conditions. At a certain price by a certain date are those strictly defined terms and conditions. So when you buy the stock, you're covered, okay? Because as the seller, you're obligated to provide the stock. And I'm going to go through that in just a second. Now, you can also, of course, sell one option contract against every 100 shares of any stock you already own. Okay. So let me walk through a quick example of this and then show you some results. Here's a theoretical, kind of the anatomy of a covered call trade. I go out and I buy 100 shares of XYZ stock and I pay $60 per share. Right, we'll do this as a buy right. Right, this is one trade. I buy 100 shares at $60 a share. At the same time, I sell one XYZ option with 45 days to expiration, and it's the $62.50 strike price, it's called. So these are the strictly defined terms and conditions. At a certain price, I sold someone else the right to buy XYZ at 62.50 sometime within the next 45 days. Now remember, I bought the stock at 60. To go back to our quote, someone was willing to pay me $2 per share to take my stock away at a higher price. Right? They paid me to do that, which means my net debit or my cost basis for the XYZ shares is now $58 per share because I bought it at 60 and I got paid $2 per share by an option buyer. Okay. Now we'll do a little what if scenario. At expiration, which again in this case is 45 days to expiration, what if XYZ is above 62.50 at that time? So if the buyer has a right to take the stock away from me, that means I'm obligated to give it to him. Right? I'm obligated to provide that stock. Now, if I didn't already own the stock, I'd have to go out into the open market and buy it, and that's very risky. That's called a naked call. We would never do that in our retirement accounts. They wouldn't let you. However, when I own the stock, it's a very prudent conservative trade because I'm already covered, so I'm not going to lose any money if the stock goes up. So if XYZ goes above 62.50, right, when you take into account our cost basis, it means we made a profit of $4.50 or 7.5% return on our investment in just 45 days. Okay, so remember what our objective, it's all about objectives. I don't care what type of trading account you're in or investment account. It's all about objectives. And our objective here was to generate a safe, steady income. Before anybody types it in, or if you might be thinking of it, I don't care if XYZ goes to $75 a share. It wasn't my objective when I purchased the stock and sold the call option. 4.5% in 45. I'm sorry, yeah, 7.5% in 45 trading days. I'm sorry, calendar days. The next what if is what if XYZ goes below 62.50 at expiration? Well, we already know that we took in $2, or it's actually 3.3% lower than the original price. In other words, we lowered our cost basis. We don't own it at 60, we own it at 58 now. So in other words, there's what we call a cushion built in. The stock can actually go down and you can make money, or at least break even down to 58. Now, of course, if XYZ goes below $58 a share, losses will occur, right? Why? Because you own a stock. So first of all, selling covered calls as a buy right is a bullish trade because you own the stock. But remember, the risk doesn't come from selling the covered call. It comes from owning the stock. And so we have very precise risk management techniques that we use to protect our covered call and our buy right trades. Okay. So that's just a theoretical, that's the anatomy of a covered call and why it can be so profitable for you. I put it on a graph too just to show you. So that was theoretical. Sometimes folks like to see it on an actual graph. So don't worry about the time or even the stock. It's Dollar General. It's the concept I want you to take away quickly here. You buy 100 shares of Dollar General and you pay $112 per share. Let's just say it's a buy right, and simultaneously you go out and you sell a call option with a 115 strike price. That's the strictly defined term and condition. That's the strike price. That's the price at which the buyer of a call option can call away your stock from you. Now, I sold them the right to take my stock away at a higher price, and they paid me $2.65 per share, or $265. Okay, that's the scenario. Now, if the stock goes down, as we said on the previous slide, profits from the call you sold help to minimize the loss on any position, which would be mitigated again because we'd have a trading plan in place. If the stock moves sideways or moves down just slightly, we'll actually still make money because we keep the call premium. Plus, we can also sell another covered call against the stock that we already own and continue to lower the cost basis and generate the income. And then, of course, at expiration, if the stock goes up, we would make our max profit, right? Because we know going in what our max capital gain is, and some will look at that as a disadvantage that our capital gain is capped. But I say just the opposite. It means that you've put on the perfect buy right trade. You were called away and you reaped the greatest reward that you could, which was the max profit you knew going in. Why? Because that was your objective. So having it called away is actually a very good thing. So in this case, at expiration, Dollar General actually did close at 119. So we would have made $300 in capital appreciation and another $265 in the premium that we collected, which would be a gain of $565. Again, safe, steady income. Now, here's an example. We use AMD, and this is part of, again, a more specific, I'll use the word trading for our weekly buy rights. Right? We do a weekly buy right trade in our retirement coaching group sessions that we have. And here's an example of actual trades that we placed. This goes back a little over a year. This began back in June. And each time we bought anywhere from 200 or 300 shares of AMD, simultaneously sold a call option against them, and in this case, using again a very specific management technique, we were able to capture these returns throughout the second half of 2019. And I can tell you we've had 4 other profitable trades through 2020. This is just one stock. This is not the only one we use, but it happened to be a great candidate. So we had 6.8%, 7.4, 4% here, another 5%, and you get the picture here. We've had 3 more profitable ones in the second half, well, in 2020. Okay, so when done right, finding the right stock at the right time and aligning the trade with the market trend, it's again a great way to generate a safe, steady income in your portfolio. Okay, Okay, so that's income. That is part two. Um, and now let's go to capital preservation. All right, now I want to talk about what I believe is most important, especially in this illogical market. As it's my new phrase, I'm stealing that from you, Tom. Let's talk about preservation of capital. First, I'm going to talk about protective puts, and this is going to be on individual stocks first. Okay. Now, again, this is really where this quote comes in. There are reasons to worry about the market and about individual stocks. One of the reasons is because maybe an earnings report is coming up. Maybe the VectorVest program signaled a confirmed down call or a DEW down. Maybe there's a Fed meeting. Maybe there's a million different things going on that might have you worried about your net worth. So, what I need you to do is look at what I'm going to talk about right now as an insurance policy. You have assets that you need to insure. And in this case, it's your retirement nest egg and your brokerage account. Right? So we're going to be proactive. And I want you to keep the idea that it's an insurance policy. In other words, protect your assets. Okay, protect your assets. The reason we buy put options is to protect our individual stock positions, or you can use them to protect or insure your entire portfolio. We use it to reduce risk. Right? This is the manage part, right? This is why I can't say I'm going to show you how to build a retirement portfolio. That's useless, right? If you can't build and manage it once it's built, then you're going to have problems at some point. Okay. Remember, you insure your home, your car, your life, your health. Heck, my wife and I have insurance on our two dogs. Okay. So it only makes sense that if there's a way to insure your retirement net worth or your nest egg, that you would want to be able to do that. Let me walk through a scenario and just introduce what a put option is, right? So let's say we're going to use a scenario of Texas Instruments. Again, don't worry about the time frame. It's the illustration I want you to take away. So let's say you bought the stock here, or who knows, maybe even down here when the VectorVest timing signals were telling you it's okay to buy a good quality stock. Okay, for our purposes here, we're gonna pretend we're gonna illustrate that we bought it right here, right? I bought the stock here. I've got a very nice gain in the stock. It did exactly what I expected it to do in a rising market and a good quality stock. Now, there are reasons why I would need to be proactive and protective of this position and place an insurance policy. So I could buy a put option. What is a put option? Well, remember earlier I said a call option gives the buyer the right to buy 100 shares of stock at a certain price by a certain date. Well, a put option gives you the right to sell 100 shares of stock at a certain price by a certain date. It gives you the right to sell. So the value of a put option goes up when the value of your underlying stock goes down, just like an insurance policy would. If you owned an asset that was damaged and you had insurance on it, the value that you'd get paid from your insurance policy, your asset is damaged, but you got paid. So I want you to keep it that way in that state of mind. Okay, and the other thing I want you to keep in mind is that if you own the stock, it's just under $100 using our example here, and it went all the way up to $120. If you own, again, we'll just say just 100 shares, that's a $12,000 asset. That's a 20% gain. I know this is your cost basis, but I want you to look at it as though I own the stock at 120 now. And I'm not, listen, we know it could pull back some, and it most likely will, but I own the stock up here now. And I'm certainly not willing to allow it to come all the way back down to $100 and give back the profit that I earned. So that's the mindset I want you to have. That's why you could go out and buy a put option or an insurance policy at a strategic time for a reason. There's always a um, due diligence that we do to determine. Usually an earnings report is a big one. Okay. Now I could buy the right to sell my Texas Instruments at 120 when it's trading there, or I could buy the right to sell it at 115. So what's the difference? Just like an insurance policy, if you want a no deductible, a good quality insurance policy with no deductibles, you're going to pay a little bit more for it, or a lot more maybe. But it's if you want a less expensive insurance policy, then you don't mind taking on a little bit of deductible, and it's okay because you're going to pay less. It's catastrophic insurance, right? In case the bottom falls out here. All right. And Dennis, I'll talk about the overall portfolio in a moment. This is just an individual stock. Let me walk through this case study, and it's pretty straightforward. So I'm going to go through this. So we bought the stock here uh, in November. Again, don't worry about the year or whatever. Right? We got a confirmed up call. We bought a good quality stock in a rising market. We had a 20% gain, roughly 2 grand. That's your money. You own it here now. Now, because we do our due diligence on every stock, we know that earnings were coming out very soon. In this case, usually the window I want you to do this is about a week to maybe 10 days. Right? You're going to become proactive. In this case, because we have an asset that has an event coming up, we're going to go out and buy an insurance policy. I'm going to pay $4.23 per share. I'm going to buy that, in this case, the more expensive one. Again, you could go down and buy the 115. Either way, it would have served the proper purpose. Why? Because what happened? Even good quality IRS stocks sometimes will come out with an earnings report that doesn't meet somebody's standard. And in this case, the stock gapped down over $10 or right around $10. So what happened? Well, as I said, the value of the put option increases when the underlying stock falls. So our insurance policy is now worth $1,128 or roughly $700 profit. We had an asset that was damaged, and our insurance policy covered a good portion of that damage. Had you not bought insurance in this case, right, you would have given up you'd still have a profit, but you would have given up half of it because you didn't react or be proactive, I should say. But had you bought the put option, you would have profited $700 from that, and you would have mitigated that loss down to only $300. Okay, so you drastically minimize your losses on a percent basis. That's just one example of owning 100 shares of a stock. Over time, now sometimes, and before anybody types it in, if you didn't need the insurance, if Texas Instruments numbers were good, okay, and the stock rose, you would have lost, let's call it roughly half of that $423, maybe a little bit more if you hold on to the put option. Okay, but here's the way I want you to look at that. I have car insurance. I have Geico, and every month they withdraw automatically ACH the premium out every month. I go to my bank account, I look, I see that that Geico took more money out. I don't get mad because I didn't total my car this month or that a tree didn't fall on my car. Right? I don't get angry. It's an insurance policy in case something goes wrong. Think of it that way when you think about okay, well, this is costing me money and I might lose some money. Okay, because it really does help to mitigate your losses in a portfolio. So I know the answer, so I won't ask you to type it in, but if you had the choice and understood how basic and easy it was to buy an insurance policy instead of suffering the catastrophes that never happened, as Mark Twain said. I've suffered a great many catastrophes, most of them never happened. Right? And it doesn't have to happen if you buy insurance. Now, somebody asked, Dennis asked earlier about the entire portfolio. Let me walk through the same scenario, but only on the overall market. So you can do them on individual stocks, but you can also protect your portfolio by buying put options on the S&P 500. And for our purposes, it's going to be the SPY, which is the ETF that tracks the S&P 500. I'm going to walk through a scenario. This slide I created before the February crash, before the mayhem began. I was trying to make a point in a presentation that yes, this market has gone pretty much straight up, but that it was still important to understand that you have to know how to protect your portfolio. This was created before the the fall there. And I was saying that if you're going to look at this, I don't want to hear that, well, the market's going up, I don't have to worry about insurance, everything's going to be fine because, look at this. Okay, because if you're going to talk about this kind of move and the kind of move we're seeing now since March 23rd, when the S&P hit, when the markets hit the low on March 23rd, that's what I'm afraid everybody's feeling now. But don't talk to me about that move without talking, and I know this is October of 2018. And in this day and age, October of 2018 is an eternity ago, right? Unfortunately, that's the way we seem to look at it. But I'm begging you not to, right? The market crashed over 20%. It would take, and I know it popped over a little bit, but before the actual run began, it was over a year before you got your money back. Remember, if you lose 50% of the value of your portfolio, you need your portfolio to double, to go up 100% just to break back to even if you are not proactive and protect your portfolio. Okay, so while I didn't foresee a pandemic knocking the market down, there were other indications to be worried about a toppy market before all of that happened. So I'm going to zoom in now. If I zoom in here even more, right now I have the February sell-off. And I'm going to walk through a couple of quick scenarios and show you how you could have protected your portfolio just by placing the easy trade of buying some put options on the S&P 500 or the SPY ETF. So we have a prudent timing signal in our program called the DEW, Detrended Price Oscillator Envelopes 30-day weighted moving average. That's what it stands for, but it's a VectorVest DEW. Very, very good timing signal. On February 24th, it went to the downside. Okay, that's something that shouldn't be ignored. Be proactive, do something. So we become defensive. What could we do for our overall portfolio? Is buy a put option on the SPY. The type of stocks we build our portfolio in are those larger cap S&P 500, big Dow names, and so the SPY is a great way to cover those when the market turns against us. Here's the scenario. Oh, I'm sorry. And so just 4 days later, by the way, if you ignored the DEW, just 4 days later, the confirmed down, that's our final line in the sand on a downtrending market, came just 4 days later. Okay. So if you skip the DEW, you certainly better become defensive here. So what does it look like? I'll zoom in one more time and build a theoretical, well, not even theoretical, in a little different way. We protect our portfolios. We protected a lot of the drawdown that we saw. We mitigated that drawdown. How? Well, on 224, the DEW timing signal went to a down situation. It's a good time to place a put option on the SPY. Again, this one is theoretical. You could go out and buy an SPY put option. This would be at the money. This is an at the money put. That's where the SPY was trading on that day. Right? You could have done it the next morning. It wouldn't have mattered. I'm not breaking this down to the penny here. I'm illustrating the power of a put option. You would have paid $9.75 per share, or $975 to protect your overall portfolio. You could have bought 2 or 3 of these. It would cost you somewhere around 2 or 3,000. A little less than that, actually. That's, again, not to protect one stock, but your entire net worth. Well, your entire nest egg in the market, anyway. Okay, so what happened? Well, just, I don't know, how much longer was that? Not even a month later, that 322 put option was trading at $71 per share, which would come to a $628 return on investment or an insurance policy payoff of $6,000. Right? The value of the put option went up when the value of the SPI went down. Now, let me be clear. I'm not saying that you would have, well, you should have bought it somewhere right around here because it was a clear signal. When you got out we do have risk management techniques and trading plans that we use, but I just chose this date. If you had waited till that date, even after it bottomed out and went back up, you still would have profited from the put option, which is the portfolio protection, which mitigates that drawdown just by buying a couple of put options on the SPY. Now I'll do the same thing. This is from the confirm call. So let's say, okay, because we didn't know exactly where this was going, and we could never know, but we can still be proactive. So 4 trading days later, or calendar days later, we get the DEW, I'm sorry, the confirm down. Be proactive. Here you would have paid more because we waited. Now the SPY was down to 296. Again, just not even a month later, it was up to $67 per share, and you still would have had a huge insurance premium payoff. Now, again, I'm not saying I would have held it right to here, right to the bottom. I'm saying anywhere in this range is helping to reduce or mitigate the loss from the drastic sell-off in the market. And that's how we mitigate these type of drawdowns. Right? In our model portfolio, we not quite, almost cut that in half. Our plan got us into all cash, and our investment plan also got us back into the quality stocks and are moving back up now. Okay, so those are the 3 core strategies. I talked about growth portfolio on high safety stocks. That's the kind of returns we can see. Again, I talked about how to mitigate those drawdowns. I talked about changing gears a bit, how you can get both capital appreciation and strong dividend and steady growth from strong dividend stocks. And then finally, I showed you in part 2 of income how you can build a system, scan through, find the proper underlying stock, and then match it to the best option trade, right? Because a good quality stock doesn't necessarily mean it's going to be the best covered call trade. So there are certain parameters that we have to use. And then finally, I talked about protective puts for individual stocks, and this is the same slide I used before, and overall protection of your portfolio. Okay. So, as I said earlier, after my conversation with Dr. D, and he told me, James, just tell him to keep making more money. Well, that ultimately became, as someone asked earlier, our ultimate retirement solution. Right? There was an actual origin story for that title. So it's with that goal in mind that if you're interested in learning more about the plans and the techniques behind all this and how to, it's only so much information I can give in an hour or so, but it is with that goal in mind, I invite you to take a few minutes and let me explain to you the Ultimate Retirement Solution online course, where we'll show you how to protect and grow your retirement nest egg. Okay? It's designed to take you by the hand and guide you through the method you need to grow and protect your retirement accounts so that you can retire with that peace of mind we talked about earlier. Very quickly, there are 6 modules. There are 6 lessons here. And again, each one builds on each of those core strategies. Win Before You Begin is module 1. I can tell you from my experience, which has been a long time here and in this business, that if you don't define your objectives, write them down, set your goals, that you are not going to be successful, or it's going to be a lot harder to be successful. I'll say it that way. So you have to be able to lay out the foundation, those objectives and goals. That's module number 1. Then we'll go right into building your growth portfolio. How to find not just ruler stocks, but good quality stocks that meet the checklist, setting up the plan of knowing when to buy them and what type of management techniques we apply. So we can get, remember I showed you over 33% in the last 3 years versus 17 for the S&P 500. Okay, you don't have to just buy a passive index fund and do what the market does. Next, in Module 3, we talk about building, again, your quality dividend growth portfolio. Identify those characteristics I talked about. Select the proper strategies and set up the risk management techniques that we do for our dividend portfolio to get those returns which also beat the S&P 500 over even a longer time frame. Module 4 is all about generating consistent income with covered calls. Again, I mentioned earlier it's the most common, the most basic income option trade. And in Module 4, I'll walk you through uh, the anatomy of the trade again in more detail. We'll set it up and more importantly, the trade management techniques that we have. And I can show you real quickly here. I have a spreadsheet for our group. So far this year alone, now we didn't do any during the sell-off because you had to buy stock. We didn't want to do that. But we've got 18 round-trip trades. We got 15 profitable trades. And I've got 4 trades open right now that are all, well, CNC is about flat, but the others are profitable right now. One of them is AMD. Earlier this year, I told you we had other trades other than I showed you. AMD is up. We had 1, 2, 3 profitable trades with AMD as well. It's an 83% success rate on our trades. And for the capital that we use, it's about a 15% annualized rate of return. Okay. Module 5 may be the most important, again, using Ray Dalio's logic, that we want to be sure that we can make money. This talks about building the portfolios, again, with management techniques. But if we're not defensive, we're not going to get to keep our money. So we'll go into much greater detail into those scenarios of buying either protective puts on the individual stocks or on the overall portfolio. And we'll even talk about a trade called the collar trade, where you combine selling a covered call and buying a protective put. It's a great trade on stocks that you have a nice unrealized gain. It's a very low cost insurance policy that every retiree or retirement minded investor who's managing their own portfolio should definitely understand and know how to place. Finally, we're going to go through Module 6. We'll implement the plans. We'll talk about allocation of funds. We have checklists. And it's also here where we'll walk through the very specific game plan of selling covered calls, a weekly trade. Once a week we do them. And we'll show you how to implement that plan. And I'll go deeper into that spreadsheet that I showed you in a moment. Now, along with all of that, there's a lot more that goes. That's just the core modules that we teach. Along with that, if you are interested in learning more here, we have 6 live mastery support sessions for each module that I just talked about. Those modules are found in the University of VectorVest.com, and you watch those, you learn from those, and then we have a live mastery session to help you implement what you learned, look at what you're doing, help to guide you. And don't worry if you can't make the live session. In the digital course, we archive each day. So a few hours after the actual live session, it will be available to you. So that's a very helpful thing. We love doing those to make sure everybody's on the same page for each module. My favorite thing I mentioned earlier, our retirement coaching group. Now this is kind of a separate group, but as a student in the Ultimate Retirement Solution online course, you'll be invited to 6 weeks of the retirement coaching group every Tuesday at 2 p.m. Again, if you can't make it, we archive the recording later that evening. But we'll walk through our retirement portfolios. We have a growth portfolio, we have a dividend portfolio. We have what we call the retirement income portfolio, which is the covered call trade. I'll show you exactly how to do your due diligence. Make sure we don't have any events that are coming. Do we need to be proactive? Should we buy the SPY puts for protection? We'll go through all of the nuances to understand that. So it's a lot of fun. I love doing that every Tuesday, 2 p.m. Eastern time. We do that. If you can't make it, we still archive it for you. There's a great bonus module. My colleague, Mr. Ron Wheeler, is nobody better at teaching credit spreads. Right? He'll do a bonus module with you. Open another income stream, selling options for income. Again, not a covered call, but credit spreads. They're very high probability trades like the covered calls, and Ron will walk you through that. It's a great bonus section. If you are in the room and you are new to VectorVest, we'll give you 60 days access to the program, the intraday program. It's a great tool to determine market direction and find those good stocks, and will dramatically reduce the amount of time that it takes to find them. So those are all, there's a lot of resources that go with the course. It's not just those 6 modules, it's digging deeper than that. The total value of the retirement training course, the 6 live mastery sessions, the VectorVest intraday software, the bonus module. All of these things add up to about 2,500 bucks. That's the value each on their own. But for the URS course, because you were kind enough to join me here tonight, the regular price is $995. We have what's called the early price at $595. Okay, that's going to expire tomorrow at 5 p.m. However, because you took the time to be here, we're going to give you what's called the fast action bonus, and we're going to knock another $100 off. So you can have all of those mastery sessions, the coaching group, a dedicated email bin, the the 6 modules plus the 6 live masteries for just $495. You can go to vectorvest.com/URS. John was kind enough to type it into the chat box, so you can click there, and I'll go to that screen in just a minute. But you can sign up right there. You have till the end of the webinar. Actually, it'll be, that price will be available for a short time after. If you have to sit, deliberate, think about it for a little bit, that price will be available to you for a little while. But act this evening, and you'll take advantage of that price. That's a lot of bonuses, a lot of resources for just $495. Now, they say in the market there's no such thing as a risk-free trade. This kind of is, right? After the course is over, if you show you've done the work, or logged in, we can see if you logged in and watched the videos and stuff, and you're still not satisfied, VectorVest will give you a 100% refund on your money. So it really is a risk-free trade to walk through the steps, piece by piece, on how to build and manage your portfolio. VectorVest.com/URS. John typed it in. You can go ahead and click there. The question I ask, or more importantly, you should ask yourself, is what will it cost you if you don't do this, if you do nothing? How much money will you lose, or how much potential profit will you miss out on? How much time and energy will you spend trying to figure this out on your own? Then ask yourself how life may be different if you do it and it all works out. Okay. It's never too late. They say that the best time to plant an oak tree is 20 years ago. And the second best time is, right? That is, today. So it's not too late to do this. Take advantage. Only $495 on our fast action bonus. Some folks will ask, when are the live mastery sessions? These are the dates. It's every Monday at noon, except for September 8th, because that's Labor Day. They actually give us the day off. So every Monday, the bonus session will be Monday, October 12th. It's noon Eastern time. They're all live. They're all recorded for you, and archived in case you can't make the live session. So a lot of information there, a great step-by-step guide, a great way to remember. Module 1, I said, was laying out your goals and objectives. And that's what we do in each module moving forward, for growth, for income, and then for capital preservation. I believe you're here because you are building and managing your retirement nest egg. Okay. We're here to help you do that. So that's what we do. So what I'd like to do is a couple of things. Let me first, while I'm talking, John will come in and see if there's any questions that he might see there that I have missed because I'm talking, so I can't get to every question that comes up. But if you have a question, you can type it in now. What I'll do as you're thinking about that, or as John will come in a second, when you go to vectorvest.com/URS, you'll see a great overview of the course. You can scroll through that and read through it. You'll see that our special pricing, and this will be here for a little while after we're done here, $495. It really is not much for all of the resources that come along with it. If you click purchase the course now, it will bring you, my computer's thinking, there it goes, to the VectorVest order page. It will give you the product. Simply click proceed to checkout. Again, that $495 price will be there. Now here, if you are new to VectorVest, we just need some basic information so that we can get you that 60-day trial period. And just click submit and it'll walk you through the process. If you're already a member of VectorVest, just hit sign in. It will ask you to put in your username and password. Um, I'll just put mine in here real quick to show you where it'll bring you. And we'll hit sign in. Well, something went wrong there. Why did that go wrong? I typed something wrong. Anyway, that's where it will take you. I don't know. Maybe I typed my password in wrong. But that's where you want to go. You'll just sign in to that page, and it will bring you in following that there. So I'll ask John to see if he's got any questions I might have missed. I'll try to answer any and all. There's still folks here in the room, a lot of folks. So uh, let me just say, if you did go in and you signed up, let me know that you're in. Let me know that you signed up. We'd love to see you here and let you know what to expect after you sign up. And Michael, I can tell you the elite price. Remember, the price of the course is $9.95. As an elite member, we cut that price in half for you at $497.50. So, as I said earlier, we'll help you make money. I'm already raking in the cash for you. Save an elite subscriber $2.50 if you sign up at this 495 price. But Michael, if you don't, you will get the 497.50. Okay. And there's Brian. Brian said he just signed up. Fantastic, Brian. Thanks. I look forward to seeing you in the course and all the modules and the coaching group. I think you'll enjoy the coaching group a lot and the modules. We get to really dig down into the specifics of what we do. What'll happen is, Michael, you'll get an email soon. Not, I hate to put a time for not, the next 5 minutes, but sometime very soon, you will get an email with all of the instructions that you need to access the digital course in the university.vectorvest.com. It'll give you everything you need to get there. Uh, and by the way, the course becomes available to you right away. The 6 modules will be available to you right away, and then we'll have the mastery sessions each week. So remember, there's a difference between the module that I walked through and told you about, and then the mastery session. So we do the module, and then we have the mastery session to review it and answer any and all questions. Okay. So Brian, thank you for joining. Anyone else who's in, let me know.
Jim,
Yes, John. What do we got?
a question. How long will they have access to the content for?
Great question. Yeah, I'm sorry, I forgot to mention. So when you sign up for the course, right? You have it's the online course, and you have access to this course for 1 full year. The live sessions, the coaching group sessions, which will be archived, the modules. There are video resources. I forgot to mention there are video resources uh, in uh, in the course, and you have access for 1 full year from the end of the course. And again, access to a dedicated email bin that you'll be able to send us questions or comments or anything that you might need. So yeah, that's a good question. 1 full year.
Next question here is from Tony, who's wondering if this course will be applicable to Canada stocks.
Yeah, great question. Yeah, I saw a few folks from Canada, and the answer is yes. The concepts that we teach, the ability to use VectorVest to find good quality stocks at the right time for growth, the ability to find quality dividend paying stocks and growth dividend growth stocks, is all part of it. The idea of protecting your portfolio with the options and selling covered calls, there is also a place there, but here's where it differs a little bit. The option markets in Canada and in our other databases, Australia or the UK, all of this applies to you guys as well. But just understand the options liquidity is not as much. It's a little more difficult to find stocks to sell covered calls on than it is on the U.S. side. The dividend ideas are there. The growth and the market trends and timing is all there, of course, and selling covered calls and protective puts. But to be honest, the liquidity is a little harder. So hopefully that helps.
Hey, Jim, I'm looking
Yeah,
at Sunita's question. I'm
yeah,
not sure what she's asking.
yeah. Let's see. Computer by Dino, trader. Sunita, yeah. So if you're new to this, so you'll get access to VectorVest, and then you commented on a brokerage platform. I can tell you this that in the coaching groups on Tuesdays, okay, we don't have any one platform that we say is better than another. We have uh, alliances with Ally, not Trade State, yeah, Trade Station, and Interactive Brokers. We don't really go into a lot of that in the retirement side right now, but uh, on our Tuesday sessions, for instance, I use TD Ameritrade or the Thinkorswim platform. So we can help a little bit with the platforms, and we go in and we actually enter trades and things. So we will talk about that. That's a big part of the Tuesday sessions. So don't forget, you get the module, you get the mastery session, and you get the Tuesday session for the 6 weeks. And Sunita, John, that's a good question. Would it be this Tuesday they're invited? Not tomorrow. I think next Tuesday would be your first invite.
Yes, it will be next Tuesday.
Next Tuesday, right? Because actual sign up for the course, the early bird pricing ends tomorrow at 5, and then I think Wednesday is the official opening of everything. So it would be next Tuesday. Well, yeah. Well, these are the mastery sessions. These are not but it would be that same week. It would be next Tuesday. And then on this
Jim, September the 1st.
September September 1st is oh, is that when the first
Yes, that was one day because the mastery session is next week on Monday.
the
So the
31st?
very following day, yeah, very following day, September 1st, is the first
The first
coaching
coaching.
session.
Okay, good. Thank you. Okay, great.
Yeah.
Perfect. Yeah, so that Tuesday, thank you, John. Yeah, September 1st will be the first coaching group, and you guys will get a link and you'll get invited. One thing I forgot to mention, by taking the course also, we have trading systems built into the program that only folks who take the URS course have access to. I forgot to mention that. And there's still folks here. Let me get in this really quickly here. Bring up my VectorVest account. And if there's any questions, like I said, John and I are here, and we'll answer anything you've got. So yes, Sunita, on Tuesday, September 1st is the first of the 6 coaching groups you will be invited to. Yes, September 1st, 2 o'clock Eastern Time. So what I wanted to show real quick. So if I go into a portfolio and my portfolios, and I want to create either from a back test or from a portfolio, VectorVest has a great way to choose. It doesn't matter what I write here. To choose a trading system, right? You can build your own, or you can select an existing investment plan or trading plan. So in the trading system viewer, what I do is I sort by, because there's a bunch of them. I sort by market timing because of all of our retirement portfolios are through here. So I start there. So our dividend portfolio trading system is right here. And all you have to do is hit select and you can set up a portfolio. Okay. And the great thing about this is for taking the course, one of the bonuses, I guess you call it, is that you'll see you have to take a course to get access to that. Actually, I didn't say that here, but you do have to take the course. Otherwise, you won't have access to those trading systems. So that's just another bonus that we get for being part of that. Just thought I'd throw that in there. Mark's in Austin has signed up. Thank you, Mark. Appreciate that. Again, keep an eye out. You're going to receive an email with all the instructions that you need. Of course, if there's any questions, you can always call our product support. They'll walk you through anything, but it's really pretty straightforward, Mark, and you'll get that very soon. And you'll have access through, again, university.vectorvest.com to the digital course. And so you'll be able to get started and then remember the live sessions that we have coming up. And yes, Sunita, again, I think if I'm reading your question correctly, is yeah, it is a uh, risk free because if you don't if you're not satisfied at the end, we'll give you your money back. And I don't know, John, if you could type something in there, maybe help Sunita out. If you just go to vectorvest.com/URS, you should be able to get there.
Yeah, let me type that in. I'm not sure what it means by doesn't let him click.
Yeah,
I'm not sure
yeah,
what
I'm
that
not sure
means.
there. I mean, the 495 price will be up there for a little while. You may be able to call into product support and get that price. All right. Mark says I got a typo in somewhere. Is it here? Let's see. After the course is over, if you show you've done the work on the class, done the assignments, and you're still not satisfied, you will gladly give you a refund. Yeah, yeah, no, that's not a typo, Mark. You got to pay yourself back. No, I'm just kidding. Wow, that I've been using this slide for a long time. I never saw it, and no one's ever commented on it. See, Mark, maybe you should be teaching the mastery sessions. That should read I or we, not you. You will gladly give you a refund. Thanks, Mark. I'll make sure to fix that. Thank you. All right. I'm pausing only because I'm looking to see if any other things, if any other questions have come in, or if there's anything else. I'll give you guys a second because there's still folks here. I'm trying to think if I've missed anything. Um, yeah. All right. I want you guys to focus more on covered calls, Michael, than our grammatical errors. You'll gladly get a refund. Yes, Michael, that's it. But here's the thing. I believe that anyone who does sign up and takes the course will be satisfied and won't need the use of that slide. That's my uh, that's my goal anyway. Mark says, "Can I generate 33% income per year?" Mark, listen, we talk about in our coaching group, and we've had results where some years obviously are better than others. We have annualized rate of return numbers, but I can tell you um, using these techniques, we usually say somewhere between 15 to 25% will grow between income and between capital appreciation. Uh, we have had, as I showed on the ruler stocks, there are times where certain years or certain time frames will be better than us, just the way the market works. But I know from my time working on Wall Street. Actually, I was on the corner of Broadway and Wall for a long time ago, and I knew a lot of money managers and brokers and who who would have sold their mother to be able to beat the S&P 500 even slightly. So we're talking about 15 to 25%, and at times even more. Um, but I believe we can significantly outdo the S&P 500 over time without a doubt. John, is this your best program for someone facing involuntary retirement sooner than expected? John, we have a lot of programs here at VectorVest, and they range anywhere from actively trading to introducing you to um, um, investing just in stocks without the options or call options. There's a wide range of programs that we have here. It's hard for me to answer which is best. It would depend upon your objective. and what you were trying to do. Like again, we have anything from swing trading to uh, basic investment to the retirement group. So um, I listen. I think this will help you without a doubt. I think any of them would help you. But if you want to take the course, and if it's not what you were looking for, like I said, you will gladly give yourself a refund. Okay. Mark says, "What is the S&P average for the last 20 years?" That's the question. And I'm going to go ahead and answer that question. I'm going to answer that question. And at the end of my answer, I'm going to go ahead and sign off and thank all you guys for being here. So if you have a question while I walk through that, um, I'll answer them. But I'll use that as kind of my what do you call it? My encore. So what has the S&P 500 done? How can we do that? Well, the easiest way for me, the way I know, is to go to our stock viewer page. And if I go to the stock viewer page, I can type in the symbols SPX. I guess I could use SPY as well, but I always use the SPX, and I can change my date. And let's take our date back to, oh heck, where do you want to go? You want to go all the way back to 2000? I could go back to, I think, 96. I'll go to 2000 because he asked for 20 years. August. What's today? I'll give you exactly 20 years. 8/24 of 2020. I'm sorry, 2000. Right. So that's what the S&P 500 or SPX was trading at. All I got to do is quick test and it will come back. And here, I'm glad you asked that question because here is where, listen, at any given time, the S&P can soar like it has since September 23rd, hitting new highs, right? This is a 20-year look at the SPX. It is up 6.3% annualized rate of return. Okay. I'm not going to run them all now, but I can almost guarantee we use back tests. I have all of our blue chip dividend payers, our ruler stock portfolios. I have 1, 3, and 5. I go to 7 years even, which for me back test that's about as far as I need to go. 15 or 20 years ago was a different world. So I use the ruler size. This is the growth portfolio. Now this is only up till, well, one of them I updated. This is up to a couple of weeks ago. But from these dates, right, you've got 28% annualized. For 5 years, you got 25. For the 1 year, you got over 20. For 3 year, you got 31.6. Right, and again, these aren't updated. I think those are even higher at this point because the S&P is hitting new highs. Here's one I used just to someone asked the question. We got a confirmed up call on May 18th. Okay. If you just bought the top ruler stocks on the morning of May 19th, you'd be up 17. Well, if you'd used a $100,000 portfolio, you'd be up 17 grand in 90 days. So those are just some back tests there, but good question, Mark. Okay. All right, last call. Any questions at all about anything we talked about or about signing up for the course? Remember, the $495 price will be there for a little while after I sign off here. It'll be available to you for a little while. So if you need to deliberate or uh, think it over, go ahead and do that. And even listen, even if you don't, we still tomorrow at 5 is when the $595 price ends. But take advantage, save another $100. It's risk free. And it'll be offered at $495 for a little while after I close out. And Mark, thank you very much for taking the time and for signing up. Look forward to it. Jeff just typed in a question. Says, "What's the least amount you need to invest?" Jeff, that's always a hard question. If this were an options course, It's an easy question to answer because of the leverage. You don't need much. 5 or 10 grand can get you started. For what we do, it is um, we are buying stocks, dividend stocks. We're buying growth stocks, but it doesn't mean you need $1 million portfolio to do this. 40, 50, 60 grand, whatever it might be, you still need to build and manage it, right? Even less than that. So if you, unless you want to go out and be much more aggressive or even speculative and day trade or actively swing trade, that's fine. But I can tell you this, if that's what you're looking for, and again, I want to be honest, that's not what we do in this retirement course. Okay, there is activity. Stocks do trade. I mean, it's not like we just set it and forget it and don't worry about it. Okay, but it's not an actively traded system. So, um, yeah, that no, those numbers you put in there, this will help you. For instance, that the spreadsheet I showed you in the retirement income portfolio, we haven't put more than maybe $50,000 at any one time, where we had 5 positions of at least 100 shares of a stock. And that's more of a weekly thing. We've been 1 or 2 positions for a couple of weeks. We've been up to 4 or 5. I don't think we've had more than 5 in there. Can you buy a couple of good quality dividend stocks? Sure. Can you sell covered calls? Without a doubt. Right? Can you allocate that to just a good quality growth portfolio? Sure. So, um, you can always do that, and this would apply to you. Somebody told me, well, I've got 5,000 to put into this retirement account. Um, that would be a little different. But those numbers, this will help you with those numbers you typed in. Here says, what percent of an entire portfolio would you protect? Well, Harry, we get into that a lot more in the coaching group, but we do have some quick and easy math that we like to use. So I'm looking at the SPY right now. It's trading at 342. I'll call it 343 per share. That's what it closed at today. $343. Okay. So if I were to buy one put option, let's say I bought an at the money put option, right? The right to sell 100 shares of SPY at $343, right? Times 100 shares would mean theoretically, right? And that's the important word here, theoretically, if the SPY went to zero, right? Let's say I have a $100,000 portfolio and I bought one SPY contract, I would cover $34,300 of my loss. Although if SPY goes to zero, we may have bigger problems than your bank account. But anyway, so what can you do? Well, what if I multiply that by 3, right? Now I'm protecting, again, I'm using a theoretical $100,000 portfolio. I could buy 3 put options. If I were worried today about a market that may be toppy, about an illogical market, boy, I can't wait to use that one. I'm stealing that one for sure. This illogical market, and I was worried about my net worth, I could go out and buy 3 SPY put options and I could protect my entire portfolio. That's a quick and easy math. There are other ways to do it, and we talk about them in the mastery sessions, but that just gives you an idea of how a quick mathematical number there. And Jeff, yeah, we talk about calls and puts. Again, when we get to module 4 and we discuss covered calls and protected puts, I will go deeper into the definitions of exactly what those are. Again, I don't want to put it out there as if it is a um, um, advanced options course of any sort. We will walk through the definitions and exactly what covered calls are, and we'll explain options for our put options as well. So we will do that. Great. Well, good. Wonderful. Jeff, okay. Yeah, Kevin. Kevin says, how do you protect a portfolio with basically the FANG stocks, right? Amazon, Apple, Microsoft, big name stocks that you've owned for years. And Kevin, really the best way to protect portfolios like that is either to do the, and this is my opinion, because right, you don't want for anyone who doesn't want the trouble or the headache of potential tax consequences if you've owned Apple or Microsoft for 20 years or longer or whatever. If you sell a covered call against those stocks, there's a chance that it could be called away from you, right? And then you open yourself up, if especially if you're not in a if it's not in an IRA. So the best way to do that is the put options on either the individual stocks or on the overall portfolio. And those stocks in SPY, or you could even do it. If you have those stocks, you maybe use the Qs, right? The OEX, you know, not OEX, the Nasdaq 100, and you could buy put options. We also in the coaching group talk about spreads, so where you can actually lower the cost by doing uh, debit spreads. So you buy a put option at the money, and then you go out and you sell a lower strike to offset the cost. It also limits your downside protection, but let's face it, we don't really believe the SPY is going to zero, right? So we have a method to go through and kind of find that spot on the low end where we sell a put and it offsets the balance. We do a lot of that in the coaching group. Okay. All right. All right, folks. You guys stayed in the room, so I stayed, but I think I'm going to go ahead and wrap it up here. Again, vectorvest.com/URS. If you're still thinking about it, that 495 price will be available to you for a little while. Thanks for the folks who did sign in. Thanks for the folks who have stayed on. I look forward to seeing you at the sessions. Again, whether you sign on tonight or a little bit later, that 495 price will still be there for you. Or even listen, even the 595 is still 100% money back guarantee. I we've been doing this course for a while. Again, I've been here for a long time talking to folks. It really can make a difference for you. So if you're kind of thinking about it and you're on the fence, remember, if you're not satisfied, we'll give you your money back. Okay. John, thank you. Paul, thank you. Donald, thank you. It's been a pleasure. I would really, really want everyone to stay safe, stay healthy, be careful out there. And if not at this course, I hope to see you at a VectorVest session in the near future. Thanks, everyone. Have a wonderful night, and bye for now.